For those of you who've been part of our workshops before, I want to thank you for being a part of this one. For those of you that this is the first time, I want to welcome you. I'm Christopher Price. I'm one of our certified financial planners. And within the many things I do, we do take one time out of our day once a month to talk about different financial topics. So again, those have been part of our workshops have seen some of those. Those that this is their first time, this is one of many for the recording because I know I did it a little late. This one's about the sources of retirement income. So for those that have been part, you've seen this slide many times. This is a term that we like to define before we get started. Now, this term financial well-being, is it something I made up? Isn't something the team made up? It's something defined by the Consumer Financial Protections Bureau. And they basically use these terms to say, where are our people and how do we get them to can check off this list? That first part of this list is having control over our day-to-day, month-to-month expenses. Basically like having a budget. It doesn't mean spending less. It doesn't mean spending more. It means understanding what we spend and making sure it's important to us. The next one is having the ability to absorb a financial shock. I can't tell you how crucial this is. We all have either gone through an unexpected expenses. We know somebody who's been through unexpected expenses, or we might have to be cautious of an unexpected expense. So having the ability to absorb that shock stops us from getting into debt. It stops us from running into a lot of bad scenarios. The third one you see is being on track to meet our financial goals. Now, the key word in this one is on track. We all know how to set goals. We may not always follow through, but we all kind of know how to set goals, especially financial ones. We may make a goal of like, I want to buy a car in 2 years, or a house in 2 years, or I want to retire at this date, or whatever the case might be. We all know how to, okay, well, if we want that, we have to save X dollars every single month. So we all kind of know that, but are we on track? Are we hitting milestones? Do we know how to keep track? And that fourth one is having the financial freedom to make choices that allow you to enjoy your life. And this is unique for each one. Maybe it's not worrying about the money you're spending as much. Maybe it's going on vacation, going out to eat, taking an extra day off, whatever the case might be. Now, today, we're going to talk about these three things. Establishing a retirement goal. We're going to talk about retirement income sources. And we're going to talk about aligning income with expenses. So we're going to cover broad goals today, as you can see. And each one of you should take some exercise and some time on your own to find out what is unique for you, because they are going to be different. So let's first start talking about how much income do we want to have in retirement. Now, a rule of thumb we all often hear when it comes to how much income we need in retirement is 75% of our pre-retirement income. So if we're making, to make math easy, $100,000, we need $75,000 in retirement. If we're making $50,000, we need $40,000 or somewhere around there in retirement, $37,500 to be exact. So that's kind of the rule of thumb. But the rule of thumb doesn't mean that's based on you. There's many things that you have to take into consideration that might be different than where you are today. You might have to take into consideration, where do you plan to retire? What age do you plan to retire? What do you plan on doing? You got to consider things like housing costs, food, utilities, transportation, taxes. And those are just a few. Really, ideally, we want to create a monthly budget. Now, when I say that word, and I repeat this every time I talk about budget, when I say that word, monthly budget, I don't want to, or you shouldn't only focus on your bills, mortgages, things of that nature. Focus on your budget, your lifestyle. All these things should be in there. Don't just focus on the things that are bare bones. Think about what it takes to enjoy it. So let's say we come up with that number of what we need in our retirement income. The one thing that's not on the slide, which I want to add though, the one thing that's not on this income slide that I want to add though, is when you are thinking about this, think about when retirement might be too. If you're retiring further out, things are going to cost more. So what today may cost $1 may cost $2 or $3 in the future. So just keep that in mind that the cost of goods are going to go up in the future. So we found out what we need. Now let's talk about some of those sources that we have for retirement income. Now, this is not the only sources. Trust me, I do retirement planning all the time. People have different sources in retirement. So you might have some unique ones too, but it would be good to list them. Some of the most common ones are like a 401k. Now, because there are people across the country here on this call, 401k in this reference represents an employer-sponsored retirement account. So yours might not be called a 401k, it might be called a 457, might be called a 403b, deferred comp, defined benefits. So there's plenty of names for that. The industry has kind of accepted 401k as a term for all that. We have IRAs, traditional and Roth. Now, IRAs are very, very common. They're called individual retirement accounts, structured like 401ks, but for the individual, and we'll talk about those a little later. We have Social Security, the most popular option for retirement by far. We have annuities, also a popular option. When it comes to annuities, also think pensions. They're structured the same way. And then other sources. Maybe you're working, maybe you have a hobby, maybe you have rental property. Maybe you have a business. There's millions of other ways, maybe not millions, but there's many, many other ways to have retirement income. So let's talk about one of the first one. What is a traditional 401k? Now, mind you, just like what I said in the last slide, when I say a 401k or reference a 401k, I'm not just saying that term. There are 403bs and other terms that we could hear that we could have at work. Let's just use this as a universal one. So because of that, most of you are probably familiar with some of the ins and outs of a 401k. So this might be a refresher, but that doesn't mean it's a bad refresher. So as you probably already know, traditional 401ks are sponsored by the employer. So we need to have an employer to start a 401k or a business to start a 401k. For a traditional 401k, not Roth, but traditional 401k, those dollars are invested pre-tax, meaning we put the money in before tax, and we'll talk about that. And that's what we're going to focus on. We're going to focus on the pre-tax. Yes, some 401ks allow post-tax contributions to be made, meaning after tax. That's based, each company is a little different. If you do have any questions about yours, obviously we'll assist wherever we can and answer whatever the questions you might have. So let's take an example of somewhat what a company 401k looks like. So a company provides a traditional 401k for their employees. The plan calls for a company employer match of up to 4%. So that's really one of the big reasons why everybody likes a 401k. There's what they call this match, this employer match. So a lot of times how this match works is the employee, you have to give a certain amount. So let's just say in this hypothetical example, you have to give 4% of your income towards this 401k. Well, the company in turn is going to match that and also contribute 4% to your 401k. So although you're only saving 4%, your retirement is actually getting a total of 8% of your income towards that account. So hugely beneficial. Now, the one thing I want to make sure everybody knows on the call is each company is unique on how they match or if they match. So yours may match a different formula that I mentioned for dollar today. Just wanted to make sure that's clear when we get started. But let's keep with that same example. Let's say that this company that you're working for does match 4%. Well, you decide because that you also want to give 4%. If you made $75,000, which you see in here, and you gave 4%, that's roughly $3,000. Well, that means you're going to pay tax on $72,000, not $75,000. So the IRS is going to tax less of your money, which is a huge benefit. And like we stated before, if the company is going to match, they're also going to give another 4% or another $3,000. Now, for those of you saying, wow, $3,000 seems like more than I was expecting when I put 4%, it accounts to about $57 per week. So you put $57 a week in, company put $57 a week in, it's hopefully invested in your 401k that's individualized, and it's going to grow for your retirement. Now let's talk about how 401ks are taxed, right? Because as we mentioned on the last slide, you did not get taxed on it. So how are they taxed? Well, they're actually taxed when you pull that money out of it. So ideally, the concept is that when we decide we want to use this money, we're going to be retired. We're going to be at a time period where we have less income coming in. And if that's the case, we're going to pay tax on this money at a lower tax rate because we've had less money coming in. So when we put that money in the 401k, it's not taxed. When it's in the 401k growing, it's not taxed. When we take it out, we tax it. We pay tax as our ordinary income of that year. Now, there is one asterisk we need to apply to this. The IRS has set up this arrangement with you that said, hey, we won't tax until you use it if you wait until your full retirement age, which for 401ks is 59 and a half. I do want to tell you that there are exceptions to that rule, but generally speaking, let's use that 59 and a half rule. If you break that agreement and take money out before 59 and a half, the IRS will tax you and they'll impose a 10% penalty on the amount that you took out. So just keep that kind of mindset cautious when it comes to what money do I have available when I do put money into this, what it's earmarked for. So just keep all those things kind of aware of it. This slide is obviously a little old, but there is an amount or a maximum we can give to our 401ks. So for 2026, not 2025, 2026, we could give $24,500 towards our 401k. Now, what that means is you could give anything up to that, but you can't give more than that. Now, if you are 50 years old this year, anytime this year, or over 50 years old, you could do a catch-up. That means you could add another $8,000 towards that $24,500. And there's also a catch-up provision for people who are 60, 61, 62, 63. If you are that age, just call me because that gets into a whole other area. But just know there is a maximum you can give towards your 401k. Each year may change. You see 2025s of what it is, and 2026 being a little bit higher. All right. Now, I don't know how many of you on this call this may be applied to, but this is an important concept. If you look at your slide right now, you're going to see something that says traditional 401ks and required minimum distributions. So you remember everything we talked about was trying to basically stop you from taking money out to a certain age. Well, funny enough, there's also a certain age where IRS requires you to start taking some money. Now, the amount you have to take out is minimal and it may not be of concern, but you have to take some out. That actual age right now is age 73 years old. It used to be younger. And for those of you who are younger on this call, yours will probably be 75. Just depends on your age. But right now, let's use 73. That means the year you turn 73, there is an amount you have to take out of your account before April 1st of the following year. Now, wherever your 401k or IRAs or anything is being held, that company will be able to assist on what that dollar amount is. Because it does change every day. It is based on your age. It is based on how much you have on that account. So it's not a fixed number. It's unique to you, to your accounts, and maybe other accounts also. So if you have any questions, again, let us know. But your provider will be able to answer that if you are 73 this year or later. Now let's talk about what is an IRA. So as I started to talk about way early on, an IRA is a lot like a 401k, but it's individually owned. So you don't need a company to set up an IRA. Anyone can set up an IRA as long as you want to. Now, can you give to an IRA? Well, you can only give to an IRA if you have earned income that year, meaning you can only take money from your paycheck or your pockets and put it into an IRA if you've earned it that year. Now, I keep stressing the word earned because it's not about you made money on a rental property or investments or anything like that. It means earned as in you worked at whatever you were doing. Could be self-employed, but whatever you're doing to earn that money. One of the biggest difference in an IRA and a 401k, besides one's owned by a person, one's owned by a company, is the amount you could give. You could give significantly less to an IRA. All the other rules kind of do apply. I hear some of you are talking, or I don't hear you, but I'm assuming some of you are talking and saying, hey, well, I know there's a thing called the Roth IRA. How does that work? And that's what we're going to address in this slide. On this slide, you see that there's two different IRAs, mainly. There's many different ones, but two main different types. There's your traditional and your Roth. Now, the point I want to make clear to everybody is this conversation is literally only a tax conversation. The investments can be the same in each one. And I want to make that clear because that's one of the biggest misnomers that I get in our day-to-day practice is some people think there has to be a certain kind of investment in their IRA or their traditional or their Roth. No, the investments between these two can be exactly the same or exactly different. The difference is how they are taxed. So let's kind of get that. If we look at our screen, we can see the first line item says for traditional IRA, you pay tax at withdrawal. Now, if you remember, that's exactly like how we pay for our 401k, meaning we paid those taxes when we withdraw the funds. For a Roth, we paid those taxes to get in to the Roth. So we paid our taxes to get into the Roth the same way we paid taxes to get into maybe our personal bank account. So it's coming on an after-tax basis. Second one, contributions are tax deductible. First one, contributions are not tax deductible. This is the exact same thing as I just told you, FYI. Traditional basically saying you're not paying taxes in the beginning. You're going to pay taxes when you take it out. Roth, you're paying taxes in the beginning. And then there are many other options, but just think about who this is for. That's what the last section is calling you. A traditional IRA is mainly for someone who's in a higher tax bracket today, and they think they're going to be in a lower tax bracket in retirement. Remember, you're only paying taxes. Where a Roth thinks they're in a lower tax bracket today and a higher one tomorrow. So traditionally, you're going to see a lot of people say a Roth should be for someone younger, because assuming they're going to make more money and they're in a higher tax bracket later. But that's not always true. Just think about it. When is the best time for you to pay taxes? Is it today when you're saving, or is it then when you're taking out? And that will help determine which one will be best for you. And then there's other considerations, which you could be a part of or not. But that one's the one that will determine what's the best for you. How do IRAs work? So besides what we just talked about on that last slide, IRAs are generally structured the same way. Now, I say the word generally. Roth does have a component of who can and can't give based on your income. There is some more flexibility also, but generally speaking, it's structured the same way. You could also give the same contribution. Now, this slide is a little outdated for 2025. For 2026, you could give about $600 more. But anyhow, the max contribution for 2026 is $7,600 for anyone who's under the age of 50 and $8,600 for anyone who's 50 or over. Cool. Traditional IRAs also have required minimum distributions, just like we talked about with 401ks. They're actually the same age as 401ks. So for traditional IRAs, they're structured the same way from an RMD standpoint as 401ks. Again, there are little aha, gotcha moments and everything. So I advise you always look at a professional if you have multiple IRAs, but generally speaking for this slide, that's there. Now, a Roth does not have any RMDs while you're living. So you can have a Roth IRA and you don't ever have to take money out if you don't need to or don't want to. So Roth sometimes becomes a planning point of, well, I want my next generation to be able to have this. So that might be a consideration why one might be better than the other. Again, if you're having those thoughts, definitely talk to your financial advisor, give us a call, do something like that, because that is more of a planning point than a yes or no answer. Next up, Social Security. So Social Security is by far the most unpopular option that people use for their retirement income. It's probably unfortunately one of the misknown ones. We know some things. We know it's for older. We know it's based on how much money we've made. We do know that we could take it at certain ages. All right. But some of the misnomers there, I see, well, there's a lot of misnomers I see over there. So we could definitely address some of them. One of the first ones I always like to address is when to take Social Security. So Social Security, for those of you who have seen a statement or went to SSA.gov, you could see 3 different ages. Now, that doesn't mean you only have 3 times to take it. Another misnomer. It's not 3 times. You could take it any time period from 62 to 67. From 62 to 70. There's some ways you could take it before that, but any time period between then. Any month you wait, that benefit increases. Now, before you reach your full retirement age, which is that middle box right there, there's other considerations you have to take into effect. But generally speaking, your benefit increases every single month you defer to take it. If we wanted to look at what that deferral is, we could kind of look at this. If you're somebody who was born at a particular time that your full retirement age is 66, if you wanted to take it at 62 and your full retirement benefit was $1,000, you'd get about 750. Or if you waited till age 70, you'll get about 1,320. Now, this does not take into effect if you are still working after age 62. So that's a consideration. It also does not take into effect any spousal considerations or anything of that nature. It's just straight that option of taking it as early as you can, taking it at full retirement age, taking it as late as you can. Oh, just make sure you know there are many options besides these 3 that you see on your screen. Cool. Another big question we get for retirement income is, what is an annuity? Now, the reason I think I get this question so much is there are a huge field of investments that are called annuities. Some work for something like this, some don't. And mind you, this is not trying to say you should have any of these things or any of not these things. It's just some of the most common things that we see. So an annuity, generally speaking, is an investment product that's offered by an insurance company. But that gives out a whole stream of different things you could have. So in today's conversation, we're talking about annuity in the form of what they call annuitization. Annuitization is, I'm going to give an insurance company a certain amount of money, either upfront, lump sum, or over time, and they're going to give me a certain amount of money for a certain amount of time. That's all that would mean. Doesn't mean anything else. This is also why you'll see your Social Security considered or called an annuity. This is why you also consider some pensions called an annuity. Just some money went in, and there's a promise that some money's going to go out. So again, there are different types of annuities, and they do work generally like I explained. You have immediate and you have deferred, meaning I can give money in a lump sum, as we see in that first section, or over time. That financial company, that insurance company, is going to invest and guarantee certain returns. And then they're going to send me a certain amount of money every month or every year for a certain number of time. Now, that certain amount of time could be my lifetime. It could be 10 years. It could be mine and my spouse's lifetime. It could be a lot of different options. You have to find the option that fits best for you, if this is the right option for you. Annuities are also something that you could do pre-tax or after tax. Pre-tax would be like if you have an annuity in your IRA. After tax would be if you didn't have it in your IRA or your 401k. Depending on how you fund this annuity depends on how the tax is. If it's pre-tax, meaning in your IRA or 401k, every dollar you receive is taxable from that company, from that contract. If it's after tax, there's an exclusion ratio, again, outside the scope of this class, but it's just saying some of that money is not going to be taxed. Additional sources of income. Now, additional source of income, again, could be a million different things: hobbies at work, real estate income, family, a million different things. We're not going to address that too much. So we talked today about two different areas of our life: the expenses we're going to have in retirement and the income we're going to get in retirement. This strategy right here is a way that we can align which income sources would go with which costs. So if we look at this 4-box method, we'll see the top 2 boxes are predictable income and necessary expenses. We all know every single month we have expenses that are going to happen no matter what. No matter what, they're going to happen. So we want to make sure in retirement, because we're going to have the same thing, that our predictable income matches what those expenses are. We can rely on that income every month. We don't have to watch the market. We don't have to worry about, is it going to come in? We can rely on that. Then the second section is income from assets, which have ups and downs, and discretionary expenses. We can decide if we want to spend it that month or not. The reason we separate that is we want our income to match how our expenses are. The great thing about predictable income is it's predictable. It's going to happen. The downside is lack of flexibility. And we know we need some flexibility in our life also. So that's why we try to put them in these 4-bucket method, where income from assets, great with flexibility, hard for prediction. So that's why we align these like this. I encourage most to kind of look at their investments as in, what is this investment's goal and is it aligned in the best way it can be? And to wrap everything up, let's review, right? First thing I would do is establish an income target. What is that right one for you? Is that 75% of your pre-retirement income? Are you adjusting for inflation? Is it a different number because you plan to change where you live, plan to change transportation, plan to change, right? Review your sources of retirement income. We all have something different. I spoke about some of the most common, but we all have something different, right? Understand the tax of your income sources. Again, taxes are going to eat away at your retirement. Are we being as efficient as we can? And understand our expenses in retirement and how our income will track that. Not only here, though, I definitely want you to make sure that you also think about things like your estate planning. That's a big one. Consider your legacy goals. All those things are huge, huge tasks to consider when you're talking about retirement income. But let's focus on this one first. For those of you who may have more questions than answers, and you want to either leave us a note or get more information from us, use the QR code on your screen right now, and we'll make sure we either reach out or answer those questions in the best fashion possible. I hope everybody have an amazing, amazing rest of the day. I'll see you next month.